Hello and welcome to Absolute Trust Talk. I am Kirsten Howe. I'm the host today of Absolute Trust Talk. This is our live stream version of our podcast at Absolute Trust Counsel, and we're very glad to have you here today. We're going to be talking about mortgages. We all know that interest rates have been increased pretty dramatically by the Federal Reserve lately in its efforts to control inflation. And this affects our ability to borrow money, logically. For most of us, the biggest and most important loan we'll ever have is a home mortgage. And rising interest rates definitely make purchasing a home a bit more of a challenge, but not impossible. Today, I'm going to discuss with our guests not only how interest rates are affecting our local real estate market, but also some of the tools that she's using to help home buyers get into this challenging market anyway. Our guest today is Janice Nugent. She is a certified mortgage planning specialist with Compass Mortgage Advisors. Janice has focused on helping people with their mortgage needs for over 22 years. She started in junior high. She has built her reputation on the ability to identify her clients' goals and needs, and she's committed to offering a higher level of service than most people expect. And I will attest to that. I've had many conversations over the years with Janice about customer service, and she's fully committed. Janice has been a certified mortgage planning specialist for over 15 years in order to help every client achieve financial freedom, build wealth, and experience their life dreams by implementing intelligent mortgage and cash flow and home equity strategies. So what I'm saying is she doesn't just do the transaction. She's looking at the whole picture, trying to make this work for the client on all levels. Her goal is always to establish long-term relationships as a trusted advisor with every one of her clients. Now we get to the bio part. Janice is a graduate of St. Mary's College right here locally in the Bay Area. She lives in Walnut Creek with her family. Janice has completed the Nike Women's Half Marathon and also America's Most Beautiful Bike Ride, which is at Lake Tahoe, and raised over $10,000 for the Leukemia and Lymphoma Society's team in training. It was very impressive. And during baseball season, she's following her favorite team, the New York Yankees, with her mom. Janice, welcome. I'm so glad to have you here.
Well, Kirsten, thanks for having me on such a special day because this is your 100th episode. So congratulations on doing that. That's amazing.
Thank you for reminding me. Yes, it is our 100th episode. I can't believe it. When we first started this podcast, I never imagined we'd get 100, but we did. And thank you. I'm excited that you're here today for my 100th episode. Okay, so we've actually, in all those episodes, never had a mortgage broker on the show. So let's just cover a few basics before we really get going. First of all, what's the difference between borrowing through a mortgage broker and just going to the bank?
Yeah, that's a good question. That's probably one of the biggest questions I get. And, a bank is where they lend you money, right? They have employees there that can go from application to the close of your transaction and then service your transaction. The difference with the broker is that we don't service. We have relationships with different lenders. For us, in order to be able to take care of so many different people in the market, not all lenders carry all the different loan products that a broker needs. For instance, like FHA or VA, or we have reverse mortgage or rehabilitation loans. So that's why we have a wide variety. We work with about 25 different types of lenders so that we have lots of choices out there.
Okay, so a bank would be lending you their money, and you're using whatever menu of programs they have in that bank. You have a little wider reach, more flexibility. Okay, well, that makes sense. Do you, as a mortgage broker, do you have a geographic area that you focus on?
I'm licensed in the state of California, so I work, everywhere throughout the state. I'm also able to do some loans for clients that want to purchase investment property, because in certain states, that's not considered a mortgage transaction. Normally, it's considered a business loan where licensing isn't available. It isn't needed. But mostly it's in the state of California.
Okay. I get what you're saying, that if it's an investment property, maybe they don't have to be so protective of the borrower.
Right.
And that's why the different certifications and what have you and licensing isn't necessary.
Right.
Okay. Okay. So let's get to what we really want to talk about. We all know, Federal Reserve has been raising interest rates, trying to control inflation. Whether or not that's working, that's a whole other podcast. But how does a rise in the federal funds rate, and sorry, my cattail, how does that affect mortgage interest rates?
Yeah, that's the next biggest question I get, because most people hear what's going on with the Fed. They usually hear after the fact. When the Fed raises the Fed funds rate, that's the rate that banks pay to borrow money between each other or from the Fed. For us, that affects your short-term rates, so that when the Fed funds rate changes, it also changes consumer credit cards. It affects home equity lines. It affects some business loans, but it doesn't affect long-term rates. Your long-term 15, 20, 30-year mortgages are all based on what's going on in the bond market, and it's all versus supply and demand, kind of like the way the stock market works. So it's a little different. So when the Fed raises interest rates, it will not affect your longer term rates. It's mostly your short term rates.
Okay. So if it has an effect on mortgage rates, it's much more indirect. It's not a percent by percent
Correct.
match. Okay.
Correct.
All right. And so it kind of depends on how nervous the bond market is getting.
Exactly.
Yeah.
And the fear in the bond market is all based on what's going on with inflation.
Yeah.
Anytime you have fear with inflation, long-term rates will go up.
Yeah. Okay. Okay. So for a typical client, say a first-time home buyer, your decision to buy, it has a lot of factors. Is it the right neighborhood? Are the schools good? Is the commute to my office good? The size of the house also, and I'm sure tons of other things. But a big one is it's got to be, what can we afford? And I think one of the things that you are doing with them is you're helping them figure out what can we afford when you are meeting with a client.
Yeah, that's the biggest thing, right? The American dream is to own a home. Now that's based on, stability and living in a wonderful neighborhood or possibly a school district for your children. But mostly people want to buy a home because it's a tax advantage, could be a tax advantage, right? And over time, they're growing wealth.
Yeah, it's an investment.
Right. So, what we look at when we first talk about affordability is, really what's going on in that person's world. What's their income or their debts or, what's their long-term plans. And when we look at affordability, we look to see what they could afford on a monthly basis. But then once we get to that point, we also look at what their long-term strategy is. Can they still afford their mortgage payment along with putting money away for their savings or for their kids' college funds or for their retirement planning? So all these things come into effect more than just can they afford the monthly payment.
Right, because can we afford it is part of the eligibility.
Right.
It will a lender lend to you, but you got a life to live too. And if it's really going to push you to the limit.
Right. And we don't want anybody to be able to just have to stretch to make their mortgage payment where they can't afford to live in the lifestyle that they'd like to.
Right. And saving for college is important and saving for retirement is important.
Absolutely.
And so, maybe we got to scale back our mortgage dream a little bit to have all of it for now.
Right.
Yeah. Okay. So you really do look at the whole picture, not just can I get you into a loan?
Yeah, that's the planning part of it. It's the mortgage. The way I look at it is, it's just a slice of the pie. The other slices are is equally as important as their mortgage payment, right?
Yeah. Okay. So now I'm not a CPA and you're not a CPA, but we're not trying to give tax advice, but for a first-time home buyer, this might change their tax situation pretty significantly. Maybe it's the first time they're going to think about itemizing deductions. If you're a W-2 wage earner, what else would you have really to itemize? So yeah. I'm sure you're talking to them about that too.
Yeah, we do a separate analysis of where their tax bracket is now, what their tax bracket may be up the road. And we do this in coordination with their tax professional. We get them on board as well, right? So, most people don't understand itemizing or what's allowed to be itemized. They don't understand that, some simple tax deductions could be part of their mortgage interest or part of their property taxes. And we take a look at that. And for me, if I can help a borrower save a certain amount of money every month because they know they're going to get a tax break, then we look at that next step up the road as, what are you going to do with that savings? Where is that money going to go? Can you put that back in your savings or your retirement or your kid's college plan? Or could you put that back into your goals of working on your home on a regular basis, right? All the maintenance things that have to be done with a home, right? Looking at roofing or painting or, even remodeling. So that's some of the things that we talk about.
Yeah. So you have to really drill down to what's important for this client.
Yeah.
Like hierarchy wise, what's really important, or maybe it goes into a vacation fund.
Absolutely. Whatever it is that they want to do, that, whatever's important to them, we add that to their budget.
Right. Okay. Right. Okay. All right. So let's get back to the big, elephant in the room, the market today. What have you seen happening with prices in this rising interest rate market?
So there's a few things going on at the same time. As interest rates rise because the Fed is trying to control inflation, it's obviously costing more to borrow. At the same time, because things are happening with interest rates, we have a scenario where it's no longer as far stretching as a seller's market. You're not seeing the big overpricing anymore that you saw for the past number of years. And that's all based on supply and demand, right? But what's happening now is, if you think about it, interest rates have gone up, but you're not going to overpay for the property anymore. So it's kind of equilibrium, right? There's more equilibrium in the market. And we found that even though interest rates are higher than what they were even as far as, May, when someone's not going to overbid for that property and stretch, with their savings, they're probably going to end up paying now what they were paying for earlier because they were overbidding so much on their home.
Just to get in. Yeah.
Yeah. And that's what's hard, right? You're starting to see more houses on the market. You're starting to see houses sit a little longer on the market. And that all depends on if they're overpriced. Now, if they're priced right, we're still seeing multiple offers out there. So it really depends on that scenario. But you're no longer seeing the craziness in the housing market.
And, that's got to be a good thing for buyers, I would think. I'm over the last several years in the COVID times, I guess is what I'm talking about. I heard from so many people, they bid, and they just can't get in. And so now that's easing up a bit.
Yeah, it is. It's becoming more affordable for especially the first timers, because they were whatever they had to overbid for and compete with people that were buying the property maybe for investment property, or you have big institutional buyers in the market. That's starting to go away. Okay. So I think there's more of affordability out there for first timers to finally get their opportunity to own a home. And that's huge.
Sure. Yeah. And even though I'm guessing, that the interest rates are a little higher than we've seen in the recent past, they're really not super high. At least I remember when I bought my first house, I would have been happy with that interest rate that I'm seeing now,
And that's what people aren't used to, right? Over the past 2 decades, we've been in a low interest rate environment for very specific reasons, right? We've had the recession, we had the housing crash, we've had the pandemic, right? So interest rates have been kept low for a reason. But, 6% compared to them being at 18%, they don't seem that high when you look over, historically where rates have been. And people get very used to it, right? Just like they get used to spending, a certain amount. And when that goes up, that's when, they're like, wait a minute, I've been paying how much for gas? And right. It's all cyclical.
Yeah. It's what you're used to. But as an absolute matter, 6%, 7% is really not.
I usually tell people to go back and ask their parents or their grandparents what they paid for their first home. Right. Yeah. And then they understand.
Yeah. Okay.
It's not 2 or 3% anymore, but it's not 18.
Yeah. Just calm down. It's going to be okay. It's going to be okay.
Yep.
But yes, they have gone up. Yes, that makes it harder than it was on a pure interest rate inquiry.
Absolutely.
A year ago. But there are some pretty cool programs that you're able to use to help these people kind of buffer that a little bit. Why don't you talk about that?
Yeah, so these are programs that have been in the market forever, but with interest rates being so low, they weren't needed, right? And especially in a seller's market. So for instance, the biggest thing we're doing right now is a buy down program because it works really well for both buyers and sellers. For instance, if you have a seller that put their house on the market and it's been sitting for a while, people don't want to pay the price. They think it's overpriced, right? Now, most people will walk away from that and look for something else. Now, a first-time buyer can take advantage of that situation because they have less people to compete with. And if we can convince the sellers to contribute some funds, they could leave their list price at where they have it. They're getting what they want for the house, but they offer in seller credit the opportunity for the buyers to have a buy down of their interest rate for the initial 2 to 3 years. That can really help because, $10,000 to $20,000 can help a client. So they're paying 2 to 3% lower on their interest rate for the first year, 1 to 2% the second year, and then by the third year, it's back to normal. But boy, they can really save some money, and they're happy because they're getting a lower interest rate for the first initial years. The seller's thrilled because they don't have to lower their sales price. And go back to tax advantages, the buyer's able to deduct that money because it's an actual cost to the buyer. So they get to deduct it on their taxes. And what's beautiful about the buy down program is this money sits in kind of like an impound account for them. If they don't use it, because let's say interest rates may drop over the next 2 to 3 years, they'll get that refunded when they close their loan. So it's a perfect win-win situation for everybody. And it's really important right now for first timers to have some choices. Right. And options against, instead of just having to pay what the seller wants for the property.
Right.
It's a nice negotiation between all parties, I should say.
Okay. And you find that sellers are willing to do this sometimes. It's not like, well, there's this program, but nobody wants it.
Yeah. What's nice is sellers are used to listing their property and everybody knocking on their door on day one to offer above and well above
50,000 more. Yeah.
Right. So when it's sitting now and, a week has passed or a month has passed and it's still sitting, they have some choices. And those choices are either to reduce their sales price, which they don't want to do, or, they can find a buyer that's willing to work with them.
Yeah. Or take it off the market and just wait. And
they could.
Yeah. not everybody can do that. But yeah, I guess once it's been sitting on the market for a while, it gets this kind of smell to it.
Right, exactly. And some sellers are deciding to take it off the market and become landlords, but that's a whole another scenario, right?
Definitely not for the faint of heart.
Right.
Yes.
Being a landlord is not for everyone.
No, it's not. Okay. But I know that in talking to you, you have mentioned to me that, so you have that buy down program, but there are also some Fannie and Freddie type programs that can help in some situations.
Yeah, but believe it or not, Fannie and Freddie are everyone's aware of what's going on for first timers, right? In the beginning of the pandemic, first timers lost out because everybody was buying vacation homes because they needed to be out of their house, right? Or rental properties. Right. So the beginning of the year, Fannie Mae and Freddie Mac put a premium on purchasing vacation or second homes to kind of help first timers.
Okay.
To be able to get a shot, a seat at the table. What they've done recently is they've got two programs, Home Ready, Home Possible, where you can come in with as little as 3% down, and you can qualify for these based on your income. Now, normally, in order to qualify, that before the recent changes, in order to qualify, you had to make about 80% of the area median income, which means if you made that much, you probably couldn't afford the house anyway, right? But now they've changed those numbers to where now it's 100% or 120% of the area median income. For instance, Contra Costa County in some areas, now you can make up to $150,000 and still qualify for this program.
Oh.
Where months ago it was about, $80,000 to $120,000.
Wow.
Now that's a real significant change for people to be able to put it down 3%, have very low mortgage insurance, and have a reduced interest rate. So it's nice. And it's the perfect scenario for what's going on right now.
Wow. That would help a lot of people.
Yeah.
That raising that wage cap. Wow. Yeah. Good to know. All right.
It's time for the first time buyers to get their shot.
To get a break.
Yeah.
Yes.
Something's finally given for them, right?
Yeah. Good to know. Thank you for sharing that. So Janice, let's just cover, probably a lot of our listeners are already homeowners, but might be starting to think, well, maybe I should get into the investment property game. But that's a whole different kind of analysis that you go through with them. Talk a little bit about that.
Yeah, thanks. That's, that is so critical right now. A lot of people want to be investment property owners because they see that rent is going up. That's not gone down in a while, right? So if you can have your tenant help to pay your mortgage, right, and you can afford to either self-manage the property or to hire a property manager, it's a great hedge against inflation, right? Real estate is a wonderful hedge against inflation right now because you've got fixed costs instead of rising interest rates, right? Or rising inflation. So, granted, the neighborhood is still important. The age of the home is still important. The school district is still important because you want to look at resale value, right, at the end of the road. Sure. But then you also have to look at, being a landlord and what kind of risk that takes on, right? Also, what's the condition of the property and what kind of maintenance cost are you going to have on a regular basis, right? Because anything that goes wrong in that house, you got to spend money on.
You got to pay for it.
Right? Right. So, depending on how old your appliances are or, the condition and shape of the house, right? Yeah. That you have to look at. So we really look at risk. What's the risk you're taking compared to what's the opportunity cost you of the other options. But it is a great scenario for people that can afford to put down 25%. Some people are smart and do this where maybe their kids are going to college, right? Yeah. So they become a landlord, but
Their tenant is their kid.
is their kid going to college, right?
And
that can save
friends.
a whole lot of money, right? And think about your tuition costs, but your living costs for your college age kids. So that's what we look at. Just the risk involved, and also how differently it is as far as your tax return, right? Because
now you're a business.
you own a business. You have an income producing property that you have to report, right? But then you also have a lot more expenses to use as tax deductions. So, again, it's really critical to look at those numbers for affordability, but also get that tax person involved to make sure that we're all on the same page.
Right. Because taking the tax advantage into account can really change the possibility.
Yeah, absolutely.
Yeah. Okay. Well, let's look at our questions. For those of you watching us live, you are able to put questions in the comment section. I think everybody knows that by now, but just letting you know, if you are listening to this as a recording or watching a video recording, too bad. But you can send your questions to us, info@absolutetrustcounsel.com, or you can always get in touch with Janice directly. But now we do have some audience questions. Okay, with interest rates rising somewhat rapidly, are people still able to get pre-approved for a loan? Oh, that's a good question.
Yeah, so in the volatile market that we have, it's educating the clients on what could possibly happen between getting approved and them closing. So for instance, what I do is I tell them in their pre-approval, here's what the market is today. Here's where your rate is today. Here's based on my analysis of where I think the market's going to be in 30 or 60 days. Here's what could happen. So let's be a little safe here and let's qualify you at a higher rate to see where we're going to be up the road, right? Because you don't want to ever put a client in a situation where they're at their maximum, because then that could all change.
And they don't have any room to negotiate.
Right.
Yeah.
Right. So you have to be strategic about it and conservative about what you're doing.
Okay. That's
it's, sometimes it's, interest rates change just like the stock market does. So it's constantly moving.
Right. Yeah. It's not just every month when the Federal Reserve meets. It could be yesterday it was this rate and today it's this rate. Yeah. Okay. That's such a good point. Okay. How have ARMs changed since the Great Recession? I think that means adjustable rate mortgages. Am I right?
Yeah. So that's a really good question. And here's something. Normally, adjustable rate loans are lower because they're all based on a shorter fixed period. You can get an adjustable rate loan for a 3-year, 5-year, 7-year, or maybe even a 10-year, where it's fixed for that time and then it's going to adjust, as compared to your long-term 10, 15, 30-year fixed rates. So what's interesting right now is we're actually experiencing what's called an inverted yield curve, where 30-year fixed, those long-term rates are lower than adjustables. The market is flipped. Usually an inverted yield curve means that we're going to lead into a recession. It's one of the, indicators.
Yeah.
So when people say, oh my God, interest rates are so high, what's going on with adjustables? And I tell them how high they are. They're just flabbergasted. And I have to explain what an inverted yield curve is. So yeah, usually it is a very good opportunity for people to have a lower interest rate, take advantage of that if we have a strategy, again, for what they're going to do with the money that they're saving. It's all based on, what the strategy is. But right now, long-term rates are lower than your
actually
ARMs.
A better bargain. Okay.
Yeah.
That's fascinating.
Amazing.
But it does make sense if you're thinking we're heading into a recession. Yeah.
Right. And, the great news about how low interest rates have been over the past number of years, how many people that owned a home were able to take advantage of refinancing during the pandemic?
Yes.
Right? They're all in very low interest rates. And I think that there was a statistic I saw recently. Over 48% of homeowners across the country have more than 50% of equity in their home. So when we look to see what's going to happen with the housing market, it's not necessarily something where we're assuming there's going to be a big crash, because so many people have that equity built up.
They have a lot of equity. Yeah.
And they're all in fixed rate loans. No one's stuck, right? No one's stuck in a, not a lot of people are stuck in high interest rate loans. There's no more prepayment penalties out there. So it's a completely different scenario of where we are now as compared to where we were when the housing market crashed.
Yeah. That's a good point.
Yeah.
Okay. Let me just double check and make sure I didn't miss any questions here. Okay. So thank you so much, Janice, for your knowledge, your expertise, for sharing that with us. I'm sure a lot of listeners got a lot of benefit out of this. So thank you so much. I really appreciate you being here. I'm glad it was you on my 100th episode.
Well, congratulations. Thank you so much for the opportunity. And, I think right now that this talk is really critical of what's going on in the market. And again, I'm excited. Your 100th episode. That is amazing.
Woohoo. Okay. So thank you, Janice. And thank you all for being here today. We love having viewers. We love having listeners. If you'd like to support our podcast, you can find it and subscribe. We'd love that too. If you have any questions, just get in touch with us here at Absolute Trust Counsel. Thank you so much for being here on my 100th episode. And I look forward to connecting with you next time.
Thank you for joining us today for another episode of Absolute Trust Talk Live. If you enjoyed listening in, then don't forget to subscribe. You can find us on Apple Podcasts or wherever you may listen by searching Absolute Trust Talk. While you're there, we would also love for you to leave us a review. And then why not share your favorite episodes with family, friends, or colleagues too? You can find all of our shows and corresponding show notes by visiting absolutetrustcounsel.com. You'll also find a variety of other free resources, including our ebooks, videos, blogs, presentations, and more. If you need help with your estate planning or administration, we also offer a free discovery call to help get the process started. You can find more information on booking your session by visiting absolutetrustcounsel.com/scheduling. Don't forget to keep an eye out for our next live episode in 2 weeks. If you join us for the broadcast, you can submit questions during the show. But if not, don't worry. You can always get in touch with us by sending a quick message to info@absolutetrustcounsel.com. Thanks again for listening. We'll see you soon.